Hey everybody, it's Beau here with Beau Benjamin Realty Group, powered by EXP, and today's topic is a quick update on the market. As most people know, the interest rates have gone up. As a matter of fact, in the last 90 days or so, they've gone up over a point. That is rare. The raise of the mortgage rate would reduce or curb buyers from being in the market, right? So it's getting more expensive for the same home. And that's not because of the price of the home, although that's also going up still in today's market. The price of the mortgage payment is going up because when you add a point to your base interest every month, that raises your payment. So I saw an example the other day where the same house was $1,300 or $1,400 mortgage payment. Due to the point higher in interest rates, that same house is now $1,700 with the additional interest. So that's a big jump in that one example I was looking at. But it just goes to show that a buyer that could afford the $1,300 that didn't pull a trigger 90 days ago is now looking at that same home, same type of home, same price of home, and now it's going to cost them $400 more, and they're really not getting anything for that money. It's just interest. That curbs buyers' desire to be in the market. That person may decide, I don't want to buy a house now, I'm just going to pay rent. However, they're going to go look at the rent prices, and the rent prices are also increasing about the same amount. It's a seesaw battle of where does the buyer want to be, where does the person want to be as far as home ownership versus renting, etc., and the budget they have to work within. So at the end of the day, what does that do for the future of real estate? We have a severe supply and demand problem, and I'm going to show you some graphs that show you why. Builders have built to a degree in the usually 11, 12 million per decade range. I'm looking at this chart. In the 70s, the home builders almost built 12 million homes. 80s, they pulled back, it was about 10 million. 90s, it looks to be about 11 million. 2000s, by decade, it was over 12 million homes. After the Great Recession in 2008 through 13, that knocked out many of the home builders from building homes. They went out of business. Home prices were down, people were selling en masse, trying to get out from their bad mortgage that they probably received in that first part of the decade. And so builders weren't building because they didn't see the clients in the marketplace. When you adjust that by population, it gets even worse. This graph here, it was flat building wise based on population, 80s, 90s, 2000s. Again, 2010s almost cut in half. I would say definitely cut in half based on this picture. So why does that matter? Well, the population kept growing, right? We have the millennial generation is the biggest generation since the baby boomers, and they all need homes to live in. At the same time, the builders weren't building. They were either knocked out of the marketplace, went out of business, or they were just building at a much slower clip just based on the Great Recession. Well, that slowly went on and on and on for the remainder of the decade, and we saw the house prices climbing because supply and demand started to get offset. As the balance of supply and demand started to wane a little bit, the homes started getting purchased within a couple of weeks to a month. As that supply and demand continued to grow further and further apart in 19, 20, 21, that's what put us here today. What's going to happen with these interest rates now? So the interest rates peel off some percentage, we don't know yet, of the buyers. We're in a much different world than we are today. Our real estate industry is really built on a solid foundation because of 2008 and what happened. So there was a lot of regulation put in place. Things were switched and processes were switched, so there's not as much opportunity for predatory lending anymore. Things like that really give us a solid foundation in the industry. I have great mortgage partners, and they all are looking out for the best interests of the clients. It's just not as easy or possible to put people in bad loans as it was back in that time frame. So everything's shored up. Yes, the interest rates rising will cause a little pullback from some buyers, but here's the deal. If you are a buyer watching this video, think about this. It's at 5% roughly now, give or take, whatever. I don't know the rates. Ask your mortgage professional for each daily rate. The documented average in the United States is between 6 and 7%. While the rates at 5, like, man, I missed it. I missed the opportunity to get in the high 2s or whatever it was at the lowest. Don't let that put you in a bad mental position to where you don't take action, because the truth is, if rates continue to rise over the next 5-10 years, water always finds its level, right? So if the average of all time is between 6 and 7, that's probably where we'll average out or go back to in rough terms. I don't know when, but as a buyer, I know that 6 and 7% is worse than 5. Don't sit on the sidelines. Don't run to the sidelines because we didn't get in at the 2s or 3s, because you still have a chance to be better off than if you wait 2 or 3 years from now. So put yourself in a good position, stay in the market. We do this every day. We help people out, we buy homes. They're so happy when they get home ownership, and that is still the American dream today. So if you have any questions about this market update, please feel free to shoot me an email, a text, or a call. We'd be happy to go over your numbers and your situation individually. But we're really excited still to be in a great market in the real estate industry and a great city here in Indianapolis for home ownership. I hope this helped you out and helps you make a decision for you and your family. If you need anything, give me a call. Thank you.